So in the last video, we finally turned that intimidating list of pairs into a simple map. 3 families: the majors, the crosses, and the exotics. And I kept saying the same thing about the majors. They're the cheapest and the cleanest to trade. I even threw 2 words at you: spread and liquidity, almost like it was obvious why they matter. But I never actually stopped to show you why they hit your wallet. So that's exactly what we're fixing today. By the end of this video, you'll understand what the spread really is, why you pay it on every single trade, whether you win or lose, and how liquidity quietly decides whether your trades are cheap and smooth or expensive and messy. Once you see this clearly, you'll never pick a pair the same way again, because you'll finally spot the price tag that was hiding in plain sight. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So let's start with the spread, because it's probably the most misunderstood cost in all of trading. Here's the thing nobody tells a beginner. A currency pair doesn't have just one price. It has 2. There's the price you can buy at, and a slightly different price you can sell at, and they are never quite the same. That tiny gap between the 2 is the spread. The buy price sits a little higher, the sell price sits a little lower, and the space in between belongs to the broker. It's how the market gets paid for matching you up with someone on the other side of your trade. If you've ever changed money at an airport kiosk, you've actually met the spread already without knowing it. The board shows one rate to buy euros and a worse rate to sell them back. Lock up, swap your cash one way, then immediately swap it straight back, and you'd come home with less than you started, even though nothing about the euro itself changed. That little slice the kiosk keeps is the exact same idea as the spread in Forex. Now, here's why that little gap matters so much. The moment you open a trade, you're already paying it. You buy at the higher price, but if you wanted to close that instant, you'd only get the lower one. So every single trade you take starts its life slightly in the red, before the market has moved a single inch in either direction. Let me make that real with actual numbers. On Euro USD, the most liquid pair on the planet, the spread is often less than a single pip, sometimes just a fraction of one. On a standard-sized trade, that's roughly $1 or $2 of cost, barely a scratch. You'll hardly even feel it. Now swing over to an exotic, something like the dollar against the Turkish lira, or the dollar against the South African rand. There, that same spread can balloon to 20, 30, sometimes 50 pips or more. The exact same trade size that cost you $1 or $2 on Euro USD can suddenly cost you $30 or $40 just to walk through the door. And that's the part that catches people off guard, because this cost is invisible. There's no separate fee, no line on your screen that says you were charged this. It's baked right into the price you're already looking at, which is exactly why so many beginners quietly bleed money through the spread for months without ever realizing it's happening. And watch out for one more trick tied to this. A lot of brokers proudly advertise 0 commission, and a beginner hears that word and thinks free. But the money has to come from somewhere, and very often it's simply built into a slightly wider spread instead. So a commission-free account usually isn't really free at all. You're just paying through a cost you can't see, rather than one you can. It also stacks up with how often you trade. If you take 1 trade a week, a wide spread stings, but you'll live. But if you're jumping in and out 5, 10, 20 times a day, that little gap gets paid over and over and over. For an active trader, the spread isn't a rounding error. It's one of the biggest running costs in the whole business. Let me put a real number on that so it actually lands. Say you're a day trader taking 10 trades a day on a pair where the spread costs you around $5 to get in and out. That's $50 a day handed over before you're even right or wrong about the market. Over a 20-day trading month, that's $1,000 paid straight to the spread. Run those same 10 trades a day on a tight liquid major, and that bill could shrink to a fraction of it. The pair you pick literally changes the size of the check you're writing. So if the spread is the price tag, liquidity is the thing that sets it. And this is where our two words finally connect. Liquidity just means how many buyers and sellers are active in a market, and how much money is actually flowing through it at any given moment. Picture a huge, crowded marketplace where thousands of people want to buy and thousands want to sell, all at the same time. In a place like that, you can always find someone to trade with instantly and at a fair price. That's a liquid market. And Forex, at around $9.6 trillion a day, is the most liquid market in the world. Now, flip that picture around. Imagine trying to sell something in a nearly empty village, where maybe one or two buyers wander through all day. You either wait forever for someone to show up, or you slash your price just to get anyone to take it off your hands. That's a thin, illiquid market, and an exotic pair in the dead of night can feel exactly like that empty village. When a market is that deep, three good things happen for you. The first is tight spreads. With so many players competing for your trade, nobody can afford to charge you a wide gap. Someone will always undercut them. The majors are the most liquid pairs, so the majors are the cheapest. That's the whole link, right there. The second thing is clean execution. When you hit buy, there's always someone right there to take the other side at the price you expected. And that brings up a word you need to know: slippage. Slippage is when you ask for one price, but actually get a worse one, because the market shifted in the split second your order went through. In a deep, liquid market, slippage is usually tiny, often nothing at all. But in a thin one, it can be brutal. You click buy expecting one price, and the fill comes back noticeably worse, simply because there weren't enough sellers sitting there at a level you wanted. That difference comes straight out of your pocket, and you never agreed to it. The third thing is smoother movement. Deep participation tends to iron price out. You get fewer of those wild, random spikes, and fewer of the ugly gaps that leap straight past where your stop was sitting. A thin market, by contrast, can lurch violently on a single large order because there's nobody there to absorb it. So now you can see the full picture of what a low liquidity pair really costs you. Wide spreads, so you pay more just to get in. Nasty slippage, so you get worse prices than you asked for. And erratic, gappy movement, so the chart itself is harder to read and quicker to punish a mistake. That's the exotic shelf we warned you about last time, and now you know exactly why we did. Here's one more layer, and it's an important one. Liquidity isn't fixed. Even on the majors, it rises and falls with the time of day. When the big financial centers are open and overlapping, liquidity is deep and spreads are tight. But in the quiet hours, late in the trading day, or across the weekend break, liquidity thins out, spreads widen, and prices can gap. We're going to map that entire clock out later in the series, because when you trade turns out to matter almost as much as what you trade. So here's something practical you can do the moment this video ends. Open your trading platform, pull up any pair, and look at the two prices it quotes you, the buy and the sell. That distance between them is the spread, sitting right there in the open before you risk a single cent. Then compare a major, like Euro USD, to some exotic, and you'll watch that gap widen in front of your eyes. Get in the habit of glancing at that number before every trade. It's one of the easiest checks in all of trading, and almost nobody actually does it. So let's bring it home and answer the question we started with. Why do spreads and liquidity actually matter to me? Because the spread is a real cost you pay on every trade you take, win or lose. And liquidity is the force that decides whether that cost is tiny or painful. Trade the deep, liquid majors, and you get tight spreads, clean fills, and a smooth chart. Drift into thin, illiquid pairs, and you'll pay more, slip more, and fight a messier market the entire way. Cheaper and cleaner isn't a slogan. It's real money staying in your account. So we've now spent this whole chapter learning the market as a whole. What a pair really is, the three families it falls into, and the true cost of trading them. Starting in the next video, we get specific. We're going to meet the 7 majors, one personality at a time, and we'll kick it off with the 2 most popular starting points of all, Euro USD and GBP USD. Which one should a beginner actually start with? The calm one or the fast one? That's next. I'll see you there, trader. So, trader, if this video brought you more clarity, Like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.